When you buy a stock, you probably don't own it the way you think you do. You believe you own shares in Apple or Microsoft or Tesla. You think your name is on a certificate somewhere, proving your ownership. The reality is far stranger. The real owners are three giant ghost corporations you've never heard of. These invisible entities control trillions of dollars in assets, but remain almost completely unknown to the public. They are the true masters of the stock market. And their existence reveals a fundamental truth about modern finance. The system you think you understand is not the system that actually exists. Imagine you open an investment account at a broker, Fidelity, Charles Schwab, Robinhood, or any of thousands of online platforms. You deposit money and buy 100 shares of Apple stock. You receive a confirmation email showing you own the shares. Your brokerage account displays your ownership. You can sell them anytime. From your perspective, you own these shares, but legally and technically you do not. Your broker owns them. Your broker's name appears on the official records. You are the beneficial owner, a legal term that means you have economic interest in the shares, but not legal title. The legal owner is your broker, acting through a system called street name registration. This system emerged in the 1960s, when the volume of stock trading exploded and the old paper-based settlement system nearly collapsed. In the old days, stock certificates were physical documents. When you bought shares, an actual certificate was printed with your name on it, delivered to you, and you kept it in a safe or a safe deposit box. When you wanted to sell, you had to physically deliver the certificate to the buyer's broker, who then recorded the transfer. This system worked when trading volumes were manageable, but as volumes exploded in the 1960s, the paperwork became overwhelming. The New York Stock Exchange literally ran out of physical space to store certificates. Messenger boys were running through Wall Street carrying bags of stock certificates. The system was on the verge of complete breakdown. The solution was to eliminate physical certificates and move to electronic registration, but someone had to hold the legal title to the shares on behalf of all the actual owners. A new entity was created in 1973 specifically for this purpose, the Depository Trust Company, or DTC. The DTC is a subsidiary of the Depository Trust and Clearing Corporation, DTCC. It operates like a massive vault for stock certificates. Except in the modern era, the certificates are just electronic entries in a database. When you buy a stock, your broker sends an instruction to the DTC. The DTC records the transaction in its system. The legal title to the shares is registered in the name of Cede Company, a subsidiary of the DTC. Your broker maintains a record that you, the customer, have economic interest in those shares. But Cede Company is the official owner. This creates an extraordinary concentration of power. Every stock traded in the United States, with rare exceptions, is held in the name of Cede Company at the DTC. Cede Company owns trillions of dollars in shares. The DTC acts as the central depository for all these shares. It coordinates the transfer of ownership when shares are bought and sold. It manages the distribution of dividends. It handles corporate actions like stock splits and mergers. The DTC has become the infrastructure of the entire US stock market. Without the DTC, the market couldn't function. Yet almost no individual investor knows this entity exists. The structure goes even deeper. Below the DTC is a layer of clearinghouses, institutions that settle trades by matching buyers and sellers and ensuring payment is made. The largest is the National Securities Clearing Corporation, NSCC, also owned by the DTCC. When you buy a stock, your order goes through a broker to an exchange where it matches with a seller's order. But the actual settlement, the transfer of money for shares, occurs through the clearinghouse. The clearinghouse ensures that the buyer has money and the seller has shares. If something goes wrong, the clearinghouse guarantees the transaction. This guarantee is crucial because it means neither party has to trust the other. The clearinghouse stands in the middle, taking on the risk. This system creates what's called systemic risk, the DTC, DTCC, and clearinghouses are so critical to the functioning of the market that their failure would be catastrophic. They are in a sense too big to fail. They hold the legal title to all stocks. They process all trades. They distribute all dividends. If they were to malfunction or fail, every investor would be unable to access their shares or their money. The government has recognized this risk and designated these entities as systemically important financial infrastructure. They receive special protections and oversight, but they also operate with minimal public accountability. The street name system was designed to make trading more efficient, and it has worked. Trading volumes have exploded from millions of shares per day in the 1960s to billions today. But efficiency came at a cost: the separation of legal ownership from beneficial ownership. This separation creates opportunities for abuse and creates hidden vulnerabilities in the system. The most dramatic recent example is the GameStop saga of 2021. GameStop is a struggling video game retailer that should have been bankrupt long ago, but a group of retail investors coordinated on social media to buy the stock, anticipating that large hedge funds had shorted the stock, essentially betting that the price would fall. fall. As retail investors bought, the price rose, creating losses for the short sellers. The short sellers were forced to buy shares to close their positions, creating a feedback loop where rising prices forced more buying, driving prices even higher. GameStop stock rose from single digits to nearly $500 per share in a matter of weeks. Fortunes were made and lost. The event exposed hidden vulnerabilities in the stock market infrastructure. One of those vulnerabilities involved the mechanics of short selling and the role of stock lending. When a hedge fund wants to short a stock, it borrows shares from a broker who has shares in street name. The broker, holding shares in the name of Cede Company, can lend those shares out without the knowledge or permission of the beneficial owners, the retail investors who think they own the shares. The hedge fund sells the borrowed shares, betting the price will fall. If the price rises instead, the hedge fund loses money. During the GameStop episode, there were more shares shorted than shares outstanding. A mathematical impossibility that suggested either extreme sloppiness in record keeping or something more sinister. The street name system enabled this situation. Because beneficial owners don't hold the legal title to their shares, brokers can lend shares out without asking. The brokers profit from the lending fees. The beneficial owners never know it's happening. When prices rise unexpectedly, the short sellers can't find shares to borrow to close their positions. This creates artificial scarcity and drives prices even higher. The system worked this way for decades without major problems because prices mostly behaved predictably. But when retail investors organized and bought unexpectedly, the system's fragility was exposed. The Depository Trust Company maintains records of how many shares exist for each security, but these records can become corrupted or inaccurate. During the GameStop episode, there were conflicting reports about the actual number of shares outstanding versus the number of shares held in accounts. If the number of shares held exceeds the number outstanding, it means some shares are duplicated, a situation that should be impossible but apparently happens in practice. The exact extent of the duplication was never fully clarified because the DTC is not required to disclose detailed position data to the public. The entity that holds the legal title to all stocks and processes all trades operates in near total secrecy. The clearinghouse system also proved fragile during GameStop. The NSCC, which settles all US stock trades, suddenly demanded enormous increases in capital requirements from brokers. Brokers, facing margin calls they couldn't meet, restricted retail investors' ability to buy. This restriction of buying, without any corresponding restriction on selling, had the effect of suppressing the price. Fortunes were lost. Some brokers, including Robinhood, became targets of retail investor outrage. Did the clearinghouse's action constitute market manipulation? Was it legitimate risk management? The questions remain unanswered because the clearinghouses operate with minimal transparency and even less accountability. The structure that enables this power concentration is justified by technical necessity. The DTC's infrastructure is genuinely impressive. It processes trillions of dollars in trades daily with remarkable efficiency. The clearinghouses prevent counterparty risk by standing in the middle of every transaction. These are real benefits, but the cost is that a handful of entities have accumulated extraordinary power over the financial system without meaningful public oversight or understanding. Consider the implications. If the DTC wanted to freeze your account, it could. If a clearinghouse decided to restrict trading in certain securities, it could. If regulators wanted to force changes in how these entities operate, they would face technical resistance from entities claiming specialized expertise that regulators don't possess. The entities have become so critical to the functioning of the system that they have effectively captured their regulators. The SEC, which is supposed to oversee these entities, has limited ability to force changes because changes might disrupt the system that depends on their infrastructure. The shadow banking system that emerged after 2008 has made this concentration of power even more pronounced. Large financial institutions have built elaborate networks of subsidiaries and special purpose entities that interact through the DTC and clearinghouses. A single transaction can involve dozens of entities and layers of intermediation, all interconnected through the infrastructure controlled by these ghost corporations. If something breaks in this system, the consequences could propagate through the entire financial system almost instantaneously. Everyone would be unable to trade. No one could access their money. The international dimensions add another layer of complexity. The DTC is US-based, but it handles a significant portion of global equity trading. Foreign investors holding US stocks must hold them through the DTC system. This gives the United States extraordinary power over global finance. If the US government wanted to freeze assets belonging to a particular country or entity, it could do so by issuing an order to the DTC. The DTC has, in fact, been used as a tool of economic sanctions. During various international disputes, the US has frozen assets held in the DTC system. This illustrates how control of financial infrastructure translates into geopolitical power. The street name system also creates hidden leverage in the financial system. When shares are lent out for short selling, trading, the same share can be counted multiple times in margin calculations. A single share might be held by a retail investor, lent to a short seller, and counted as collateral multiple times over in the financial system. This creates a situation where the amount of leverage in the system exceeds the amount of actual underlying assets. When the system is stable, this excess leverage is invisible. But when panic occurs and leverage unwinds, the system can experience violent dislocations. The regulatory response to GameStop was minimal. A few congressional hearings were held. The SEC promised to study the issue, but no structural changes were made. The DTC remains opaque. The clearinghouses remain powerful. The street name system remains in place. The vulnerabilities that GameStop exposed remain. The next time panic occurs in the markets, the same fragilities will emerge again. Some have proposed alternatives. Blockchain technology could potentially allow direct ownership registration without intermediaries. Instead of Cede Company holding legal title on behalf of everyone, shares could be represented as digital tokens owned directly by investors. This would eliminate the need for the DTC, but this would also eliminate the efficiency gains that the centralized system provides. It would make trading more difficult and costly. Banks and brokers have little incentive to support such a system because they profit from the current arrangement. Others have proposed greater transparency. The DTC and clearinghouses could be required to disclose detailed position data, allowing independent verification of the number of shares outstanding versus the number held. This would make regulatory oversight easier and would expose manipulative practices. But the entities argue that such disclosures would compromise security and create opportunities for manipulation. Whether their concerns are genuine or self-serving is unclear because the information is not public. The fundamental issue is that the stock market infrastructure has been built for efficiency without consideration of the concentration of power that results. The system works as long as everyone follows the rules and nothing unexpected happens. But the system has no redundancy, no backup, no alternative pathway if the primary infrastructure fails. Everyone depends on the DTC and clearinghouses, but no one has transparency into how they operate or the risks they're taking. The ghost in the machine is the revelation that you don't own your stocks the way you think you do. Cede Company owns them. The DTC controls them. The clearinghouses settle them. You have only an economic interest, a claim on the value. In a normal market environment, this distinction is meaningless. But in a crisis, the distinction becomes crucial. If the system breaks, legal owners, the ghost corporations, have priority. Beneficial owners, you, have only what remains after legal claims are satisfied. The stock market is built on trust. Trust in brokers, trust in exchanges, trust in clearinghouses, trust in the entities that hold legal title to your shares. When you buy a stock online and see it in your account, you're trusting that your broker maintains accurate records. You're trusting that the DTC maintains accurate records. You're trusting that the clearinghouse will settle your transaction properly. These are usually safe bets, but they're bets nonetheless. The system has single points of failure. The concentration of power in a few ghost corporations makes the entire market vulnerable to systemic shocks. GameStop exposed this vulnerability. The next crisis will likely expose it even more clearly. Until the structure of the stock market is reformed to provide transparency, redundancy, and decentralized control, the ghost in the machine will remain unseen, unaccountable, and indispensable.